Now, Tom and Ben were born as identical twins. They liked their pizzas cooked the same way. They both played piano. They both liked to eat granola with cranberries. I mean, seriously, they were alike in just about every way. But there was one thing that made Tom and Ben different. It was how they handled their finances. So it wasn't so much that one lived lavishly or the other one was a spendthrift. No, they were both good at budgeting. They were both living within their means. They both each made contributions toward their future. And they were both frugal in their purchases, but it was their philosophy toward money that made all the difference. It was their philosophy that drove their beliefs. Their beliefs drove their goals, and their goals drove their actions. So as life was ramping up, Tom and Ben are married. Each have a toddler and also a newborn. I told you, these guys are twins at almost everything. They both earn exactly $100,000 a year, and they're both 26 years old. So let's start by looking at Tom. Tom has faithfully listened to financial gurus on the radio. I'll leave that up to your imagination. And he's kept his debt down to a minimum. He participates in his 401k at work, putting in about $1,000 a month, pre-tax, of course, into his 401k, and wants to someday be able to max out that 401k and put a little extra into a brokerage account when possible as well. He was doing really well this year in the market, and he was feeling great. He was hitting almost 12% growth this year alone. Tom wasn't going to leave his family without any inheritance if he should pass away, so as a responsible family man, he dutifully purchased a term life insurance policy, which would be enough to pay off his mortgage. And he set that term life policy to expire the same year he hoped to have the house paid off. Seemed like the logical thing to do. He saw his term insurance as a necessary evil and would pay as little as he could for it, as he heard from the articles and shows he listened to that he should buy term and invest the rest in the stock market. In addition, Tom and his wife have set up 529 college savings accounts for each of his two kids, and that said, he never really calculated the cost of college or what they'd be responsible to pay someday when it was time to send those kiddos off to college. So Tom was aware that there were fees and that was an issue with all of his investments. He felt like his passive index funds were the way to go. He had some target date funds, TDFs, in his 401k, and he enjoyed the freedom of letting those TDFs rebalance themselves toward more conservative allocations as he got closer and closer to retirement. In fact, he saw an average fee of 1% a year, assets under management fee, on all of his accounts on average. So in all, he felt pretty good about his financial future. But Tom was feeling the pinch in his payments. Since he was packing so much into his 401k and brokerage accounts, with two kids at home and always wanting to eat, it seemed, he had to finance his and his wife's two vehicles, which now totaled $1,000 a month in payments. Now that stung a little bit, but he convinced himself that 3% interest on those car payments was not too bad. Now he did have some credit card debt. He originally got the cards at 0% interest, but some issues with their roof on the house came up just before the cards would have been paid off, and he had to use those cards for roof repair. So he has about $16,000 in credit card debt at 15.6% interest, which he was not happy about. And right now, he's paying just the minimums on those cards, but he knows he'll be able to tackle those with earnest next year. Okay, so that's Tom. Set him aside for a minute. Let's look at Ben. Similarly, the twin of Tom, Ben, was also a family man. He too had a strong sense of duty and love for his wife and kids, and he was doing things just a little bit different. He did have a 401k at work, but he really didn't think it was worth putting more than the bare minimum into the 401k to get that company match of just 3% of his earnings. Now, he had done some homework and noticed that the 401k was going to be taxable in retirement, a time in the future that Ben believed our country would be taxed at a higher rate. And besides that, he realized that putting a lot of money into a 401k would keep the money locked up for most of his working years. And he valued keeping liquid access to money for the stuff of life, as he called it. In addition, he didn't like the excessive fees hidden in 401ks, and he didn't think that target date funds inside a 401k would really protect him from market corrections. He calls them correctly downturns. He also wanted to save for his kids' college, but similar to the 401k, he felt that the typical place to park the money, the 529 college savings account, had too many gotchas, fees, and exposed that money to too much market risk. Now that said, Ben was no cynic, so he did have some fun with his small brokerage account, and the money he played around with and tried his hand at in various investments over the years, some of them had turned out okay. And he wasn't making any contributions to the brokerage account. Rather, it was just sort of popping up and down. Just like his brother Tom, this year he was up 12% on a small brokerage account, but he believed you should only invest money you can afford to lose. Everything you cannot afford to lose, like your retirement or your college savings, should be saved instead. So, where did Ben do all his saving? Well, since he saw term insurance as basically flushing money down the drain, and since he had all this extra cash from not packing money into an illiquid 401k or 529 plans, several years ago, Ben started a specially designed Bank on Yourself whole life insurance policy. This was a dividend-paying whole life policy. He already had a decent sum saved in there, and every month he was faithfully packing in a sizable chunk of his paycheck into his policy. Now, he started this policy before he was even married. But now that he was married, he felt good coming into the marriage with this sizable asset. And he knew that since it was life insurance, his family would be taken care of if something should happen to him. Now, he used the policy once or twice already. Once for his car that he bought the year before they got married, and once for the down payment on their house. It was really nice getting access to money, which was, of course, originally meant to retire on, but now he's using it for the stuff of life. Now, he didn't have any car payments or credit card debt, but he did have a policy loan against his Bank on Yourself policy, and he set that up with his Bank on Yourself professional back when he and his wife bought their house. They were able to pick their own repayment schedule, and they chose an amount that worked with their overall budget. Now, they're on track to pay off their policy loans in the next 3 years, in time to use the policy cash again to buy his wife's next car. Now, Ben has enjoyed his first policy so much, he hopes to start one on his wife, even on each of his 2 kids, as soon as they get another pay raise. Okay, so fast forward. Now we're 29 years into the future. How are Tom and Ben doing?